Welcome to Wealth Well Done. Together, we'll cover a wide range of important topics surrounding money and the impact it has on our lives. From the sophisticated and highly valuable planning techniques of the ultra-wealthy to the commonly underutilized biblical teachings. Together, we'll work to improve our relationship with money and our effectiveness in stewarding it well. Here's your host, Eric Scoville.
All right. Welcome to the 22nd episode of the Wealth Well Done podcast, where we go after the tactical, practical, and spiritual advice to help you do your wealth well done. We are staying right in the tactical pillar today, continuing on from where we left off last week in taxes. So last week we started to go after this big animal of taxes and how to increase your knowledge on taxes and therefore your effectiveness in how you can manage your tax exposure. So we are going to continue that even further here today. Like we said before, each episode here is going to get progressively more complicated. I'm planning on maybe doing one more after this. If you listened to the one last week, we got into a lot of details behind how taxes have evolved in the United States here over the last 100 years. Into a little bit of understanding the tax brackets, understanding what the difference between a blended tax rate is and an effective tax rate, how all these things apply. So we got into a lot of those details last week. This week we are going to get, I'd say, considerably more complicated. So buckle up, take some notes, jump into the disclaimer here. This show is intended for informational and educational purposes only and should not be construed as an investment advice. You should consult with your own financial advisor or CPA, lawyer, to help determine the best options for your particular circumstances. No statement made during the show shall constitute tax or legal advice, and our firm is not endorsed by the United States government or any governmental agency. And these opinions presented are obtained from sources believed to be reliable, but completeness and accuracy cannot be guaranteed. As I mentioned last week, a little bit of background on our practice here with Storehouse Wealth is that we are not CPAs. We don't have any CPAs on staff. We're not lawyers, but the taxes and legal issues tend to be one of the main things that investors come to us for. Now, we get a lot of investors who are interested in the alternative assets and the access to some of the stuff that we have, but mostly people, when they're coming to us, they are looking for help mainly around taxes. And so we're going to dig into that. The important to understand like the compound impact of taxes. If you were, and again, if I ever use numbers that are way off to your scenario, I apologize for that. So if you make $600,000 a year and pay, let's say roughly 200 or maybe a little bit more, 200,000 in taxes, you have $300,000 a year of living expenses, and so you're putting away $100,000 a year toward whatever type of investment, whether this is retirement assets or non-qualified assets. The impact of that 100,000 growing at 12% a year, 10%, 8%, whatever type of rate you're getting, compared to if you were, instead of paying 200,000 in taxes, let's say you knock down your taxable income to 50,000 instead. Then at that point, excuse me, not your taxable income, but you knock down your actual taxes owed to $50,000. Then from there's an extra 150 grand that you're able to put away. So whether that's you spend 50 of that and invest another 100, so now your investments went from 100 a year to 200 a year, or you are able to put all that extra tax savings to work in investments, which we're going to get into in a little bit here. You can easily see the compound effect of that. Do that over 5 years and look at how much growth you have, because now you have an extra $150,000 a year that is being invested. So you've got your contributions up, plus all of that has got compound growth on top of that. So doing that for a little bit here can make a massive, massive difference in your long-term net worth. So huge reason, incentive to focus on taxes and to study this and understand it so you can do it well. Should you have a CPA? So I've got a good friend here who Dan Nicholson, who runs a CPA firm called Nth Degree out of Seattle, and he often talks about how the standard W-2 employee or small business owner pays the most taxes of anyone. They pay the highest tax rate. And the reality is that the large business owners and the largest investors pay very little in taxes. We talked a little bit last time about that. So want to qualify that. So they still pay a lot in taxes. We said that we gave some of the stats of how much the top 1% and the top 10% pay of the total taxes that are paid into the government. I think the top, sorry, I might have these stats wrong here, but maybe like the top 10% of earners paid around 70% of the total taxes paid into the treasury. But the effective tax rate being, if we're putting this on a relative scale, of the 400 largest families, the 400 top earning families was 8%. So their effective tax bracket was 8%. So therefore, while they're still paying plenty in taxes, an extreme amount of dollars in taxes, the comparative rate, the relative rate of that is significantly lower than most people. So should you have a CPA? I mean, quality of the expertise makes a large difference in the overall amount that you pay versus the amount you retain. And so then I want to spend a little time in how to select a CPA, because this is a critical piece of this, because you should be getting tax advice from someone else, not me. So you're going to, if you are interviewing a CPA or trying to decide if your CPA is making the cut, you have to qualify. So I want to try to help you understand like what an interview might look like with them. So you need to qualify and say, like, listen, every client is different. I get that. But do you have some go-to strategies that you like to use for business owners, for real estate investors, for philanthropists? And so we'll get into a couple of these things. You have to let them know how proactive you and your financial team realistically are going to be. If you say, listen, I am hands off, you do everything. I don't like keeping books. I don't like, I just want to be left to do my own thing and show up and you tell me how much I owe in taxes, then you're going to get a different answer. But if you are going to be active with this and really lean into the whole process here, if you let them know that, then you should be able to get a different answer. Like I referenced before, they have to, liability wise, they can't offer you the same type of strategies that they could if you had a full team of professionals who are going to help you execute everything to make sure that you're doing everything correctly by the book. So if you let them know, or I guess if you're going to ask them stuff about what is their typical plan, and if they come back with, well, we'd like to use IRAs, we're going to make sure you max out your IRAs and your ERISA plans. ERISA plans is like your employer's retirement plan. So this could be a 401k, a 403b, a 457, SEP, or a simple IRA. And so we're going to say, we use those. And outside of, like, if their tax planning strategies don't go much bigger than that, then there's a good indicator that they are not going to be the type of tax planning, the sophistication that you're looking for. So, and those IRAs and ERISA plans are absolutely a good thing. But depending on your age, you might not want to push out access to everything until 59 and a half. That might not be the best plan for you. So then, at that point, you give them another chance with some additional context. Say, hey, I'm a business owner. And then are they asking, do you pay your kids? If you have an S Corp, are you using the Augusta loophole? Augusta loophole, just for your reference, is the Augusta rule says that you're allowed to rent out your house 14 days per year. And while you claim it on your taxes, it doesn't count as taxable income for you. So you as an individual are allowed to rent your house out 14 days per year, get paid for it, and not have to claim that on your taxes. So it doesn't count against your taxable income. You still need to claim it and make sure that you are making note of that. There's a special form for that. The Augusta loophole says, hey, I'm going to have my business use my home. Business going to run on my home to help me, or so I can run my board meetings there, or other things like that. So there are ways to do that. So you're using the Augusta rule. Are you maximizing the home office deduction and mileage? Also, if you're a business owner with that, you want to say, are they going to make sure that you're doing things correctly and not leaving yourself exposed to an audit, by writing off things that you're not supposed to? Another way to qualify this meeting with that CPA is to say, hey, I'm big into philanthropy. And if what would typically happen then is they're going to talk about bunching. And so when the standardized deduction increased here a couple years back, then the strategy came out of, if you do give to your church every, let's say you give $15,000 to your church every year. If you do that, then instead of giving them $15,000 this year and $15,000 next year and staying underneath that standardized deduction, instead have 1 year where you take the standardized deduction, and the next year you give $30,000 to the church or into a donor advised fund that then gives the money to the church spread out over 2 years. So that way you're able to take advantage of a higher deduction there. And that's absolutely a good strategy. I certainly recommend that, but that's probably where a lot of CPAs start and stop when it comes to the philanthropic side of tax planning. So further things that we'd be looking for is like the annual gift exclusion. Are you giving away $17,000 per person? If your net worth is high enough and you're trying to move assets out of your state, are you giving appreciated assets instead of cash? And so this is a big one here. So a lot of people just give cash, but if you're sitting on appreciated assets, if you're sitting on stock in an account that if you want to give $30,000 to a charity, and you've got a stock that was worth $10,000 and has now appreciated to $30,000, you can sell the $30,000 worth of stock and pay your capital gains on that, and they give the charity what's left over. The government got all of their capital gains tax, or you can gift the stock to the charity. So you gift them that $30,000 of stock. The charity doesn't have to pay the taxes on that. They have, they don't have to deal with that. So then you're able to get a $30,000 deduction. The charity is able to receive $30,000 of the gift because they're going to sell that stock and keep all $30,000, and then the government takes none of that. So this is one of the ways we mentioned here of how you partner with the IRS. The IRS wants money to go to charities that are doing good things. So that's why they give you this opportunity. So instead of you taking a lower deduction, the charity gets less money and the government takes their cut. You can just give the charity more, you take a larger deduction, and the government takes none if you gift appreciated assets rather than cash. So that's something else you want to make sure of. If you are depending on the net, as if we're talking about a higher net worth, or if you are planning an exit in a business, we should be looking at things. Are you using like a charitable pooled trust, a charitable remainder trust, an enhanced income trust, a grant of retained trust, and there's some others in there as well. I'm not going to get into those details now, but we'll have a lawyer come on. That way they can explain those in more detail, and I shouldn't be the one to be explaining that too much. So we'll have a lawyer come on and go over those topics. But that's something else. Like we want to make sure is if you are philanthropically inclined and you're getting ready to sell a business, your CPA needs to be a high level CPA. I've talked to too many clients and friends who have come to me the year after they sold their business and they paid, close to 40% of the sale of that business went to taxes, and that just doesn't need to be. I referenced before the Tom Wheelwright, this CPA, and how he talks about all income is taxable except the 7,000 pages of the tax code are showing you how you can reduce or avoid taxes. And so the idea is to partner with the IRS. And so I want to go over some ways that you can partner with the IRS. The first one, the easy one, is retirement accounts. So most of you are probably very well aware of these, but we'll hit these at a high level here. It's an easy way to make a reduction in your taxable income. So you can either invest typically in a Roth account or in traditional. And so if they don't specify, that's typically going to be traditional. If someone just is referring to an IRA, that's typically traditional unless it's specified as Roth. The difference between that is traditional is tax deferred, meaning I invested, I made a $5,000 contribution to my traditional IRA, and therefore $5,000 came off of my taxable income for this year. But all of that money, that $5,000 and all the growth that it has, will eventually be taxable when I have to take it out, or when I choose to take it out. You have to take it out once you hit the age when they RMDs begin to apply. The Roth account is a way that you pay the taxes now. So you make a $5,000 investment, you still pay taxes on that $5,000 this year. That still stays as your taxable income, just as it was. But then that $5,000 and all the growth that it receives is then tax free. So We have some investments that we've used that are expecting a very high multiple. And so we have had clients then put those into a Roth IRA instead. And through a self-directed IRA, one of our partners there that we use, so like Midland or Millennium, these are companies who allow you to do self-directed IRAs. So you can actually choose private investments or even real estate that you want to invest in through your IRA. And if you're expecting one to have a significant growth, you could put that into a Roth IRA, and then all of the growth that received would then be tax-free. So that's certainly an option here. The IRAs, the limit this year for 2023 is $6,500 per person is what you can contribute this year. $7,500 if you are over the age of 50. There's an income limit with this. For married filing jointly, if you make over $218,000, you begin to not be able to contribute as much into your IRA. And I think at $228,000, I believe, is where that's actually maxed out, where you're not allowed to contribute to your IRA for a tax deduction. So what we do then is we switch to a backdoor Roth IRA. A backdoor Roth IRA says, I can't, if I'm, let's say I'm 50 years old, I want to make $7,500 contribution to my IRA. To my wife and I, we're going to do that. I can't make those $7,500 contributions and therefore take $15,000 off of our taxable income for the year. So instead, I make the $7,500 into a non-deductible IRA, and then right after that's done, I convert it to a Roth IRA. This is called the backdoor Roth conversion. Anyone is eligible to do this. It would just work with whatever firm, whatever custodians. So if you have your account at Vanguard, you can work with Vanguard to have them help you with that. If you have your account with your financial advisor at Edward Jones or anywhere else you have that, they can help you execute this backdoor Roth IRA. You have the ERISA plans like that I referenced earlier. ERISA plans, the most common one being the 401k. 401k this year, you're allowed to contribute $22,500 if you're under 50 and $30,000 per year if you are over 50. That can be either traditional or Roth. So that can either come off your taxable income or move into that tax-free bucket from here on out. Has nothing to do with how much you make. So you can make those contributions there. The other thing that most people aren't aware of is that there's actually, with employer contributions included in that, you're allowed to put up to $66,000 per year into that account. So therefore, if you are getting a bonus from your employer, they could put that into your 401k, and therefore, when you contributed $22,500, they could bump that up to get you up to $66,000 into that account. And all of the employer contributions or matches into this will always be tax deferred. So you will owe taxes on that. So inside of your 401k statement, you'll likely see a tax deferred bucket and a Roth bucket. There are other accounts that are used typically for small business owners. The two most common being a simple IRA. A simple IRA allows you to put up to $15,500 into that account as a contribution. I believe that is only tax deferred. That tax deferred is the only one that you can choose. I don't think you can choose a Roth option inside the simple IRA. And then a SEP IRA. So a SEP IRA allows you to put up to $66,000 into this. There are some catches with that, though. It can be no more than 25% of your total compensation. And then you have to, if you are the business owner, you have to match, whatever portion of your salary you're putting in, you have to match that for all of your other employees as well. Not the same dollar amount, but the same percentage of your salary. Does not apply to passive income or S corp distributions on that 25% of total comp. So if you're an S corp, like we talked about last week, and you are taking a lower salary and a higher distribution amount, the amount that you can contribute is 25% of the salary, not the distributions. So important to note there. So those are, in a nutshell, retirement accounts. The retirement account will allow you to invest in just about anything you ever could inside a different investment account. So anyways, that's one way you partner with the IRS. You partner with the IRS by not having to rely on the government to sustain you during your retirement. So that's certainly part of this. We referenced energy. So particularly inside oil and gas deals, you can, not all oil and gas deals where we just finished raising capital for an oil and gas deal that we bought overriding royalty interest on on some leases, and those deals do not create any depreciation. So we are not getting the tax benefits there. But if you choose to invest in an oil well, those oil wells can depreciate out at least 100% and sometimes even up to 200% depreciation on those. So these are typically done inside a group or like a limited partnership investment. And so inside those, you could actually wind up $100,000 investment could create $200,000 of depreciation to come off of your active income. So again, that $600,000 of active income, you partner with the government here and you made a $100,000 investment. Well, that $100,000 investment could lower your taxable income for the year down to $400,000. You need to work with the CPA on this because there's recapture and there's other issues that come along with this. So you need to be aware of, but especially when someone's having an exit or having a high income year, then these strategies become very, very relevant. But even if someone's just a high earner and they're looking to use some of these pieces to, again, that compound impact of taxes, they're looking to improve the amount of money that they retain instead of paying in taxes, then oil and gas are great opportunities there. It's not that complicated from the standpoint of like what we're about to get into inside real estate here coming up next. Okay, so on to real estate. More specifically housing, but real estate in general. This is one of the areas that is the best opportunity inside the tax code to partner with the IRS and really improve your tax efficiency. Real estate is one of those ways that is a great way to create a lot of wealth long term. It's not a way to get rich quick by any means. That it can be done, but most of the people who do that, it's not too far off from gambling. So, in a nutshell, the real estate play should be something that is part of your long term financial plan. It shouldn't just be a one off thing. But if you're choosing to use real estate is one of the best ways to partner with the IRS and create that long-term wealth. So I want to back that up a little bit here. The biggest thing is depreciation. We're gonna go into a lot more detail down at the end of this. So we got depreciation. Real estate income is treated as passive income most of the time. And so the income that you have inside that, what a rental property generates for you. So that's going to be treated as passive, which means you don't have to pay FICA or self-employment taxes. And that's a big deal. The 1031 exchange. So 1031 exchange is a way that you can take a property. You bought this property at $300,000 and it has now, let's pretend that you live in California, that $300,000 property is now worth $1.2 million. You go to sell it. If you sell that, then you would owe taxes on the $900,000 of difference between what you sold it for and what your cost basis is. Important to note that your cost basis probably doesn't stay the same throughout the whole ownership of that process. But for this example, we'll just use that. So you could pay the taxes on the $900,000 of capital gains, or you could choose to move that money, that $1.2 million that you took from that sale, and move that into another real estate investment. And if you do that, then you're able to just kick the tax can down the road further. And in a lot of cases in life, kicking the can down the road is not the best plan. Inside real estate is set up that you can choose to stay in real estate for life. It can be pretty easy because you can also do this passively and never pay taxes, which leads to the next piece, which is a step up in basis. Step up in basis means, and this is similar to stock, where if you bought a stock, you bought Apple when Apple was first starting. And then whenever you pass away, you have held Apple this whole time and you sell it, you hand that down to your kids upon your death, then they get a new step up in basis. So all the growth that you've had in that Apple stock along the way just gets wiped out. It's just, it doesn't exist anymore. Your kids have the cost of that stock at the day of your death is their new basis. And so therefore those taxes don't have to be paid. The same thing happens in real estate. Except in real estate, you could have made multiple transactions along the way, transitioning from one house, single family residential, to a duplex, into a quadplex, into a 10plex. And then before you know it, like you're now part of a real estate syndication that owns, some big industrial complex. And you can have migrated your money through that and never paid taxes along the way through the 1031 exchange. So inside 1031 exchange, some key things are, when you're going to sell a property, you have 45 days from the day that you close on your property to declare up to 3 properties that you were going to potentially use as the 1031 that you're going to acquire. You then have 180 days from not from that 45 days, 180 days from the date of closing to actually execute the closing of 1, 2, or 3 of those properties. You have to use a qualified intermediary, which means you never actually take possession of the funds. So on the closing of your property, those funds don't come to you. You don't touch the check. The check goes straight to the qualified intermediary, and they are held with them until you go to close on your next property. So that's a little bit how a 1031 works. It's a very, very powerful opportunity. You need to make sure that in our example here, 1.2, we have to factor in debt and some other pieces, but basically the 1.2 million, we're going to make sure that we deploy at least 1.2 million into those 1031 exchanges to make sure that everything's done properly there. Certainly, that's a key thing to please don't do on your own. Please, unless you're very qualified and experienced with that, make sure that you are working with someone else who has a lot of experience with this, because there's a lot of paperwork, there's a lot of things that need to be done right. Otherwise, you can screw that one up and wind up owing a lot in taxes still. Another thing inside real estate, you have historical tax credits. Historical tax credits are a way that, especially inside urban downtown urban areas where you have that have been a little bit more run down. Not always, but most of the time they are. And so the government will provide incentives to have people come in and rehab these buildings. So our firm and with some of the people that we partner with have we look for those opportunities. So they take a long time to execute. They might take 18 to 24 months to actually execute one of these deals before you actually begin the construction process with all of the different stuff that you need to apply for from the government standpoint. But when you do, you're able to turn a small investment into a lot of value because of these historical tax credits and what they do for your real estate. So that's certainly something to look into. But again, driving back to the point, that's one way that you partner with the IRS. The tax code is meant to incentivize you. It's not meant to figure out how they can trap you. Another one inside real estate here is opportunity zones. So opportunity zones are a way that, again, back to these kind of depleted downtown areas where the government wants to, especially on local level, they're trying to drive up the investment back into these older, dilapidated buildings. And so they have created opportunity zone funds. And what you can do is you can choose to invest in these warehouse district type situation that's trying to convert them into new condos or new commercial buildings, or commercial business opportunities. And so what happens in an opportunity zone is they're attracted to people who have a substantial capital gain that they are trying to reduce. So let's say someone owned when you go back to that Apple example, you've owned Apple stock for a long time, and now because of what's happened inside Apple, you don't want to hold that anymore. You can sell your Apple stock and work with an opportunity zone to actually put your investment into an opportunity zone. And so this would now be a real estate deal, a real estate syndication that you are part of. And at that point, if you hold your investment for 5 years within that opportunity zone fund, where they're just doing somewhat of a fairly normal construction rehabilitation and then trying to bring in rent, just like any other real rental property would, at 5 years, you can get a 10% deduction of the capital gains on your on the original investment, the one that you migrated into or migrated from. If you hold it for 7 years, that goes up to 15%. So 15% of your capital gains are now eliminated. The other piece of this is if you hold that investment for 10 years, then all of the gains that you've got on the new real estate investment that you've been in now for 10 years are also wiped completely clean. So that's where government has just created more incentive plans to try to help drive money into real estate. Okay, last one here. This is a big one. So we're going to hit on this a little bit now to lay the foundation, and then next week we're going to get into some of the strategies behind this. But this is back to depreciation. So depreciation, if you're a business owner, you depreciate out your vehicles, you depreciate out any equipment that you have in your office. But inside real estate, you depreciate this as well. If you have owned any rental property, you know that residential properties depreciate on a 27.5-year schedule, and commercial real estate depreciates on a 39-year schedule. What that means is, if you bought a $5 million building and you do nothing, you and your CPA execute no type of strategy along with that, then that $5 million building, not including the land, because the land doesn't depreciate. So we're just going to pretend that maybe it's a $6 million purchase and $1 million of that went to land, and the building itself was worth $5 million. So in that case, then the $5 million of real estate would get depreciated out over 39 years, just on a straight line depreciation. So 1/39th of that $5 million every year comes off of your, or is shown as a loss. The idea behind that is you're able to offset the gains that you would have, the passive gains from the rent that you earn. And so it's a huge benefit inside real estate. You're able to earn income and not pay taxes on it, because depreciation is basically offsetting the taxes. You need to understand, again, with this, please work with your CPA, because there's a recapture side of this. If you were to sell the real estate, if you had depreciated it out all the way and you were to sell the real estate, not do a 1031 exchange, well, then you'd be left with a significant tax bill at the end of this. You need to be prepared for how that works. And all these things are very interwoven together, which is why, again, I suggested at the beginning, you have a highly sophisticated CPA. But inside real estate, you can also do what's called accelerated depreciation. Accelerated depreciation is where you would take every building component of that whole construction process. So the carpet is going to be on a 5-year depreciation schedule. You've got a 7-year depreciation schedule. You have a 15-year depreciation schedule. And so all the building components are broken down into which depreciation schedule they fit in, whether it's the 5, 7, 15, or either 27.5 or 39-year, depending on what type of building it is. And so every component falls into one of those 4 categories of depreciation. And then everything that's in the 5, 7, and 15-year. And 15-year might be like landscaping or parking lots. So all of the value is tied to that particular category, that particular line item inside the building, is then put on that schedule. And so accelerated depreciation would say, if in this case we have on that $5 million, let's say we have $1 million of the building falls in the 5-year depreciation schedule. Well, then we can choose to have that $1 million broken out and taken as accelerate that depreciation over the next 5 years. So basically taking $200,000 per year of that, we could use that to increase the amount of depreciation we take up front. Same with the 7, same with the 15-year. Or there's this other option. So that works in and of itself. That's called accelerated depreciation. We take all of these items, they do the cost segregation study. There are firms that will go out and do that for you. And then whatever category they assign them to and whatever dollar amount they assign them to, that is how you're able to associate how much you're able to write off per year. Bonus depreciation is something that's been in play here for a while. And that is where you can take every item that falls in the accelerated depreciation category. So these 5, 7, and 15-year items, and you can take those all as a write-off in year 1. And so in this example here, let's say that there's often very little that falls in the 7-year schedule, but let's say we had another $500,000 that fell in the 15-year schedule. So now $1.5 million of our $5 million property is eligible for accelerated depreciation. We choose to bonus depreciate that, which means we take all 1.5 million of that. We choose to take that full depreciation in the first year that we put the building into service. And so what happens then is you can choose to have that come against your active income or your passive income. So naturally, it starts out as passive income. So it would be a passive loss. So if you had a large passive gain, you could choose to take all of that depreciation up front to offset that gain with the big passive loss. Or if you don't use that full passive loss this year, it will just carry forward into subsequent years. If you have real estate professional status, which is going to be something that I referenced that we're going to dig deep into on the next episode, then that is how you can use that as you can take what would be a passive loss, that 1.5 million of a passive loss, and turn that into an active loss. So that will then offset your active income. So instead of it offsetting passive gains that you may have had at 15 or 20% tax, you're able to use this to offset active gains. And so that would be able to offset that 37% tax. Interesting to note, it does not offset, you can't use that to depreciate out state tax. So in my case here in Illinois, I'd still owe 5% to the state, but I wouldn't owe the 37% to the federal government. And so again, this is how you partner with the IRS. They have created these incentives to help you do what they want you to do, and therefore get a perk in return. And so we use accelerated depreciation, we use bonus depreciation. We use that, and then we lump that together to try to create an active loss, which is how we then try to basically manufacture our effective tax rate down to the number that we so choose. I do believe in paying taxes. I am protected by the military. I am protected by the police and fire department. I drive on the roads. I drink the water. I should pay taxes. I just don't necessarily agree with the way that a lot of the tax money is being used, and therefore that's why I don't want to pay the same amount as the tax bracket suggests I should. So therefore, I play by the rules that the IRS has set forth and partner with them to lower my taxable income down to an amount that I'm more comfortable with, down to an effective tax bracket that I like. So that's what I'm using inside here with real estate and oil and gas opportunities. One thing to note on the bonus depreciation is that is currently sunsetting. So you would get all of that money that was accelerated depreciation. In this example was 1.5 million. You would get all of that up front. But now, beginning in 2023 is the first year of the sunsetting where it dropped down to 80%. So we would get 80% of that 1.5 million the following years, 60, 40, 20, and so on, until bonus depreciation sunsets out. Now that is going through Congress right now, to hopefully be put in place where that would stay back to 100% and make that a permanent part of the tax code instead of just a short-term incentive that they put in place. So more to come on that, obviously. But anyways, hopefully we threw a lot at you there. I know we threw a lot at you there. Hopefully you're able to retain that. That's valuable to you. You definitely need to dig into this and understand more about taxes, because there's the opportunities there for you to play along with the IRS, reduce your taxable income, keep more of it. Again, that compound impact of taxes. If you're able to turn, the way that I reduce my taxable income is by making the right investments. So we can invest in opportunity A, which gives me no tax benefit, or opportunity B. If you don't let the tax tail wag the dog. So if the investment is not a good investment, then it doesn't make sense. But if you were comparing apples to apples and equivalent investments, and one of them came with these big tax benefits, then that's where we're looking at this. So that's how we're playing. I'm playing this into my situation. Encourage you to look into that for yourself and see if that's a good fit for you. And we will see you next week as we go even deeper into some more complicated tax strategies, especially into this real estate professional status. Thank you.
Thank you again for listening to Wealth Well Done. Be sure to subscribe to the show on your favorite podcast player, and together we'll continue to improve our relationship with money and our effectiveness in stewarding it well.